Most Canadians pick a mortgage rate like they are picking a phone plan, whatever looks the cheapest in the moment. And for the most part, they are right. You do deserve the lowest rate. But then we get confused with fixed, variable, high penalties, 3 months interest rate of penalty versus IRD. Every bank or mortgage agent that you talk to will always talk about how what they have to offer is the best versus what the competitor has to offer, and that competitor sucks. I am a mortgage agent and I can tell you that a mortgage is a commodity. Everyone more or less has the same thing with really small differences that a lot of people, including some of the mortgage agents, are looking to hide behind the fine print. Today, I'm going to end all the confusion once and for all. This is the no bullshit guide on interest rates. 4 things every homeowner should understand before they sign any contract. So let's get started. So in today's video, we are going to discuss the fixed versus variable rate, the definition, how that differs. There are 3 kinds of rates. In fact, variable rates are of 2 types. We'll talk all about that. But then we'll talk about how they move and change. We'll do a historical comparison. We'll then talk about mortgage penalties. And a lot of people actually look at just one lens. We need to look at 2 different lenses, and we'll do that. And then finally, we talk about lowest rate versus the best rate mortgage. I have talked about this before, but I'll just clear the confusion. There are 4 main clauses that we need to avoid, and we'll talk all about that in the end of the video. First, let's talk about fixed versus variable rate. Very simply put, fixed rates are your rate is logged for 1 to 5 years. So if you have a 4%, 3%, 2.5%, even in pandemic, when people logged their interest rates, they took a fixed rate. Very few people took a fixed rate at that point. They logged in at 1.5, 1.6%, and for 5 years, they were paying that when everyone else's interest rate increased to 5, 6, 7%. So your rate is locked for 1 to 5 years, and you can lock in for 10 years as well. But unfortunately, in Canada, it's much more expensive to lock in for 10 years, and 20, 30-year mortgages that are available in US, the terms that are available that are not really available in Canada. Maybe there's a separate video on that, but yeah, your rate is locked for 1 to 5 years. That's what a fixed rate is. Your payments remain the same irrespective of what happens to the Bank of Canada. The interest rate goes down, interest rate goes up, your interest rate is fixed, and therefore, for let's say you take a 3 or a 5-year mortgage, your interest rate will remain the same, and therefore your payments will remain the same, and it's predictable, stable, boring. And this I recommend to anyone who gets nervous when there are so many announcements which are happening, then when there is so much economic activity which is happening, there are wars happening, there are trade agreements that are not being signed or being signed. There's so much uncertainty. This is a rate that is good, in many situations. We'll talk about that as well in a bit. Then there is a variable rate mortgage, and variable rates are of 2 types. It's very commonly in the mortgage world called an ARM, which is ARM, adjustable rate mortgage. This basically means that the payments change every time prime rate moves. So if Bank of Canada comes up with a 0.5% rate cut, your payments will go down. The interest rate will go down by 0.5%, and with that, your payment will also go down by the equivalent amount. So you'll be paying less interest and therefore less payment every single month. And this actually happens, let's say this rate cut happens 2 years after you have taken the mortgage, you'll still pay a lower payment because you have chosen a variable rate, which is an ARM, which is adjustable rate mortgage. Then you always pay the true cost of borrowing in real time. And this will get more clearer when I talk about the second kind of variable rate. So it basically means that if the rate comes down, your payment also comes down. That's what a true cost means. Then there's a third kind of rate, which is a variable VRM, which is called a variable rate mortgage. But in this, unlike an ARM, which is ARM, the payments stay the same. So let's say you have a $3,000 payment before a rate cut happens, and then there was a rate cut. Your payment will remain the exact same $3,000, but what would change is the amount of interest that you're paying within that $3,000. So the amount of principal that you're paying increases, the amount of interest that you're paying comes down, and therefore you're paying off your mortgage early, but it actually works the other way as well. And this we had seen during the pandemic. So if prime rises, more of your payment goes towards interest and less goes towards principal. If rates rise too much, lender forces a payment increase. This happened in the pandemic as well, when the rates went from 1.5, 1.6, even 1.1%, all the way to 6%. It was just too much for the lenders. There was a lot of risk, and the amortizations were increasing to 65, 70, 75, some cases 90 years. And the lenders were getting uncomfortable, and it hits a trigger rate. It's not just out of discomfort that the banks will increase this. It hits a trigger rate, and you have to increase your payments, and you'll be forced. And I'm pretty pretty sure if you had a mortgage back then and you had a variable rate, you would have gotten a call from the banks. And the other problem with this one is that if the interest rate keep on increasing and it's a long mortgage, right? If you continue to have a VRM rate for a very long time, the risk of staying in debt for much longer increases, because if the interest rate goes up, you are increasing your amortization because your payments are not changing unless you actually force change your payment. This is what I mean by when I say that adjustable rate mortgages are true cost of mortgage, which is why I like adjustable rate mortgages, because you are paying the true cost. If the interest rate goes up, you are paying higher interest. If the interest rate goes down, you pay a lower interest, and your amortizations are maintained. If you have taken a 25-year loan, unless you make additional payments, it will end in 25 years, and not like VRM, where if the interest rate goes up, you can actually end up paying a lot of interest for 30, 40, 50, 60 years, which is bizarre. Now, a lot of people who have taken a VRM rate where the payments remain the same, their amortizations have increased, they will actually hear back from their lenders on renewal. And that's why a lot of people are saying that renewals will be very difficult next year. The reason is that a lot of people who had the VRM rate, even though the rates have come down, their amortizations are a lot higher. They're at 40, 45, 46 years because they did not make any additional payments. Their payments remained almost the same. They increased by a little bit, but they paid a lot more interest. And that basically means that when it's time for renewal, they would want your amortizations to go down. That basically would mean that you will have to pay lump sum deposits, or you'll have to take out money from your equity if you have the equity in your home, and that can get a little bit messy. So if you are someone like that, just plan ahead. I'm not saying that adjustable rate mortgages where the payments actually go up and down, we saw that in the pandemic, it comes with its own risks. If you're buying at your brim, so a lot of people actually, overshot on their budget, and they actually bought a lot of the home, and at 1.6% interest rate, it looked affordable. But when those interest rates started to go up, their payments actually increased, and therefore it got very, very unaffordable. At one point, the interest rates actually increased to 6%. So it comes with its own risks. But in my view, there should only be two rates in the market. One is the adjustable rate mortgage, which is a true cost of a variable rate, or a fixed rate mortgage. And if you are too scared to increase or change your payments, over the course of your mortgage, if you're scared of that, then just take a fixed rate. And I don't understand why we have a VRM where the payments remain the same, the amortizations increase and decrease. I just don't understand that product. You can always reduce your amortizations by putting in more money into your mortgage. You are prepaying the mortgage. Every lender provides that. Most of the lenders would provide, 10 to 20% of prepayments, which you can do. So I just don't understand why we have a VRM. Just a psychological thing, I feel, by the banks. But ERM and fixed rates are the only two products in my view that should be available to people. The other problem with variable rates is that adjustable rate mortgages are only available with one of the top 5 banks, which is Scotiabank. So if you are going with any of the other 4 banks, you are getting a fixed variable rate, the fixed payment variable rate, and nothing wrong with that. But I am surprised as to how many people do not know this, and they just go into a variable rate thinking that it's a cheap rate, they are getting cash back, whatever, but they don't know that when the prime rate comes down, their payments will actually not decrease. They are actually expecting the payments to decrease, and then they call the bank, they call their mortgage agent, and that's when they are surprised. So if you are taking a mortgage, a variable rate mortgage with any of the banks except for Scotiabank, know that your payments will not come down or increase when there is a rate change that happens. Now let's talk about how variable and fixed rates move. First, let's talk about variable rates. Variable rates are controlled by Bank of Canada. If the Bank of Canada moves the overnight rate, your prime rate changes, the bank's prime rate changes, and therefore your variable mortgage changes. So if it goes up, it goes up, the variable rate goes up. If the prime rate comes down, your variable mortgage comes down. And it's not based on the market, it's based on Bank of Canada's fight against the economy or inflation. So if they are trying to reduce the amount of inflation, they're trying to tighten the money supply that is there, they just increase the interest rate. We saw that, and I'm pretty sure, all of us know what happened in the last 5 years. Economic impact is much bigger than just mortgages of the variable rates, because a lot of line of credits that businesses have are based on, a variable rate. So if the rates come down, the businesses can actually borrow cheaper money. They can reinvest into their businesses. They can produce more jobs, and that's what, causes employment. And on the other hand, if the interest rates actually go up, the cost of borrowing increases, and therefore they are not able to reinvest in the businesses, and that leads to unemployment because they have to fire people to protect their bottom line. Whereas the variable rates are controlled by bond yields, and the way it works is the 5-year fixed follows the 5-year government of Canada bonds. bond yields increase and decrease based on investors' trust on the equity market or the government. And let me just show that with an example. So this is a chart of Canada bond yields for a few years. During the 2008 subprime crisis, because the economy was not then doing well, the stock market had crashed, the banks were collapsing, and therefore the bond yields actually came down. The reason why it came down is because everyone started to put money into the bonds. The value of the bonds increased. When the value of the bonds increase, the yield comes down, the return comes down, because everyone wants that, and therefore they are willing to take that at a lower yield as well, and therefore the bond yields came down, and therefore the fixed rates also come down. Same thing happened during the oil crash. When there's a bull market, everyone wants to put money into the stock market, into other capital markets, and therefore they are not the bonds are not very lucrative, and therefore the yields have to go up so that it is kind of lucrative, because that's how the governments actually borrow money. And same thing happened in recessions, and then there was a bull market for a long time. We are still in a bull market, and whenever there's a volatile market, we see the rates come down. Right now the rates are actually slightly on the downward trajectory, and that's because there's a lot of volatility in the market, and people are on the bay whether the stock market will crash, whether we are at the peak, whether there's an AI bubble. So all that actually leads to the bond yields and therefore the fixed rates to move. So let's say if there's a massive stock market crash that a lot of people are anticipating, I made a video on this as well. If a massive stock market crash happens, the value of the bonds increase, because everyone would want to go to the safety of the bonds, because you're investing in the government, and government is usually safe. Your money is safe with the government. The bond yields will come down. The yields come down when the bond value of the bond increases, and therefore the fixed rates will come down. So in my view, and this is not financial advice, you should weigh in your own risks, and I do that with we do that with our clients, because we assess their risk situation and then we give our recommendations as mortgage agents. But generally speaking, if you take a variable rate right now, the possibility of a stock market crash is high, and therefore the fixed rates are likely to come down because the bond yields are likely to reduce, and you might be able to change your variable rate to a fixed rate for free, because that's what happens when you take a variable rate. You can actually change to a fixed rate for free when the fixed rates come down. Now, this happened about 2 years ago in 2023, and the Silicon Valley Bank collapsed, and therefore the trust of people in the stock market, in the overall economy, reduced. Like, they thought that the stock market will collapse. It was almost like a Lehman Brothers crash in 2008, and they thought that this would actually lead to another collapse. But obviously the government saved, and the lending norms were not that bad as it was in 2008. But what happened was, for a very brief moment, for about a month, less than a month, the variable rates, at the peak before this bank collapsed, were at 6.1%. The fixed rates were at 5.14%. There was a 1% gap, and a lot of my clients were actually taking fixed rates at that point, and a lot of my existing clients had variable rates at 6% plus. For a very brief moment, we had a collapse in fixed rates for almost 0.5 to 0.6%, and a lot of my variable rate clients actually moved to fixed rates at that point, and that was great, because right now the fixed rates are around the 4% mark, 3.8 to 4% mark, and a lot of the clients actually saved on a lot of interest all these years. And this is what happens when you're watching the market closely, and obviously I can't expect all my clients to watch the market closely, which is why we have Grow Nation. We have groups where I actually posted this, and a lot of my clients actually moved down to fixed rates, because you can do that for free. Now, the other way is not possible. If you have a fixed rate right now and you want to move to a variable rate, you have to break your mortgage. But if you have a variable rate, you can actually move to a fixed rate. So right now, depending on who you are, you can actually take a variable rate, because the chances are, looking at the economy, the fixed rates might come down, and there could be an opportunity to move to a much lower fixed rate. I would say less than 3.5%. If it gets to that, I would then again raise the alarm bells in my client community and see if someone wants to move with their existing lender to a fixed rate and fix it for 2 or 3, 4 years. Now, historically speaking, I think the last 5 years has been an anomaly. We have seen that fixed rates have been lower than variable rates, but that's not the case if you look at history. If you look at data from 1975 to 2024 to 2025, every single year the fixed rates have in fact been higher than the variable rates. So variable rates are used to being lower, and right now we only know because we have a recency bias where variable rates have been higher than the fixed rates, but that's not the case. It's only 6 instances, and even end of 2025 we are back to where variable rates are lower than fixed rates, and there has been a gap. So if you look at 2000 to 2019, before the pandemic, variable rates were on average at 3.71%. The fixed rates were at 5.94%. There was a substantial gap in this. And it's only the recent years, like recent 2 or 3 years, that this story has flipped. And it makes sense because fixed rates are certainty, whereas variable rates carry a risk. And therefore, there's a little bit of advantage that is given. And again, I'm not saying that it's correlated, but there's a little bit of advantage which is given to go with that uncertainty. So if in the next year, there are a couple of rate cuts and the variable rates are at 3%, whereas the fixed rate remain at 4%, I'll not be surprised because that's normal. That is how it's supposed to be. Variable rates are around 1% lower or sometimes even more lower than fixed rates. So whatever you're seeing right now, variable rates lower than fixed rates, it's actually normal and it's a cost of uncertainty that you pay. Now that we understand how the rates move, how variable and fixed, stack against each other in terms of what causes them to move, let's understand a very important aspect of a mortgage when you take, which is the mortgage penalty. If you break the mortgage, and one of the biggest reasons is trading up or changing homes, or they're selling a home and going back to India or going back to rent for any reason. What we need to understand is two lenses here. One is the fixed versus variable penalties because the calculations are very different. And the other one is a big bang versus a monoline penalty. I'll explain you what monoline is in a bit. Now, let's take an example of a variable versus fixed penalty. So let's assume that you have a 750,000 loan at 4% fixed rate for 5 years. I'll compare that against a 4% variable rate for 5 years. So I'll take the rate the same. Don't go by the interest rate, just go by the differences. Here, the rates are obviously not 4% right now. They are lower, both fixed and variable, especially if you're taking an insured mortgage right now. Let's assume that both want to break the mortgage in 3 years. So they are breaking the mortgage 2 years early. And the way penalties are calculated is variable rate is simply a 3-month worth of interest penalty. So what it means is that you calculate 3 months of interest. How you do that is 4% of $750,000. So 4% divided by 12. So that's your monthly interest multiplied by $750,000, which is the loan that you took, which is equal to $2,500. So monthly interest multiplied by $750,000. So that's your basically $2,500 of interest that you're paying around that every single month. You multiply it by 3 because you're paying 3 months worth of interest penalty. And that comes to about $7,500. So it's very simple calculation. Variable rates are probably the simplest way to calculate penalties. On the other hand, fixed rates are not that straightforward. It's called interest rate differential. It's a much more complex calculation. Every bank has a calculator. You can always call your bank and check on the penalties. Now, it's not as simplistic as it seems here, but I'll give you like a rough estimate of, how to calculate that. Let's assume that you had a 4% rate when you took the mortgage. Right now, when you're breaking the mortgage, the rate is 3%. So the bank actually, if you give the money back to the bank, so if you break the mortgage, you are essentially freeing up their money. They'll have to take that money and send it to, give it to someone else at 3%. So they're losing 1%. So they'll charge you for that, right? So 4% minus 3%, which is the interest rate that you took it at minus what it's like right now. So that difference, let's assume it's 1%, multiplied by $750,000 equal to $7,500. So that's 1% of $750,000. And because you're breaking the mortgage 2 years early, you'll be paying 2 times that, so $15,000. So clearly in this example, you are paying 2 times that. I've seen this number to be a lot higher because, like I said, this is a very simplistic calculation and almost all of the big banks take something called as a posted rate here, and it's much higher than what the rate that you have. Again, another topic for another discussion, but here, like I explained, it's a 2 times gap and it can be a lot higher if you break the mortgage earlier, or if you go to a big bank and their way of calculation is very different. Especially, that's the reason why I have been pushing people to take a 3-year fixed, because I know that, in the first 5 years, people do tend to change homes, upgrade for any reason, leave their mortgage, break their mortgage. And especially for my clients, I don't think we did any mortgage at 5 years. Very rarely did we do a 5-year fixed mortgage, because I know if they break their mortgage, it will be very expensive for them to break. And a 3-year is just a sweet spot. I don't think a lot of people actually break their mortgage in 3 years, even though the stats say otherwise. It's 22 months, an average first-time home buyer in their first home. But I think a lot of my clients have stayed in their homes for 3 years. And it's just a sweet spot where at 3 years, you can actually decide what you want. A lot of those renewals are coming up right now, and they can decide to go to variable or fixed depending on their situation. Now, like I said before, given where we are at unemployment, the trade negotiations, which are going nowhere, it's just hard for businesses to sustain right now. The demand is lower. People don't have, jobs. They are stretched in their budgets. I don't understand, or I don't see a reason why the government will increase interest rates. So if the interest rates are going to go down, then adjustable rate mortgages just becomes like a more obvious choice, especially now that the variable rates are lower than fixed rates. However, even if you're taking variable rates, there is one other caveat that we need to understand from a mortgage penalty point of view, and that is the different options that you have when you are going for a variable rate. Now, when you're going for a fixed rate, most of the time the top banks will be the best rates. You just need to understand the penalties and how they work, and the decision is between taking a 3-year and a 5-year fixed. But when you go for a variable rate, I want to make people understand, what different options you have. So the first one is the banks, the top 5 banks that you have. Then you have the monolines, First National, RMG, Radius Financial, MCAP, RFA. I understand most of these you have not heard of, but they are not B lenders. A lot of people actually feel that they are B lenders. They are not B lenders. They might have certain products which are B lending products, but they most of their revenue actually comes from A lending products, just like the banks. And then you have the actual B lenders, the Home Trust, EQ Bank, Avio, where you have to pay a lender fee, where the interest rates are much higher. Very different genre of lending which happens here. It's a lot more expensive. Just for disclosure, I have a mortgage with EQ Bank, which is on the B side. So, I'm not opposed to it. For self-employed people, it's a great product. But I want to compare these on these parameters. The first one is rates. And honestly, like I said, banks and monolines, when it comes to especially variable rates, it's almost the same. Sometimes you have an edge in banks, like I said, on the fixed mortgages, but variable rates more or less are the same. B lenders, they suck. It's a very specialized product for mostly, we put self-employed clients here. So the rates are usually higher, 0.5 to 1%, sometimes even higher than that. The fees, there's none. And there's none for monolines as well, but there is a fee attached to B lenders. It's usually 1% of the mortgage amount that you're taking. So that's why I gave them 3 stars. Penalties, banks actually have the worst penalties, whereas monolines have the best penalties. And I'll calculate that in a bit, an example in my next slide. And B lenders are worse than banks even because their penalties are pretty brutal. Portability is something that, if you move your home, like if you upgrade your home, you can actually take the same mortgage to the next home. Banks have that, monolines have that. B lenders almost always have that, but there are certain conditions to it. And therefore I've given, like 1 less star to them. Line of credits, banks are really good at that. All of the banks have line of credits. If you are doing more than 20% down payment, you will get, like 20%, you don't get the line of credit for your entire equity. You don't get it for the first 20%. But if you're doing a 25% down, you can actually take a 5% line of credit and you can use it for certain things, right? So, but don't use it to invest. I've made many videos on that. But yeah, you can use it for, an emergency fund or something, safety net. Run a Smith maneuver. I've talked about that as well on this channel. Monolines do not have a line of credit, which is the downside of a monoline. It does not matter if you're doing a less than 20% down, honestly, because if you do a less than 20% down, you'll not get a line of credit from a bank as well. But yeah, monolines do not have that option. They don't have that product. Then B lenders also do not have that because you're already stretched on your ratios. So they don't give a line of credit either. So banks are great here. Service wise, banks are banks. So if you call them, they'll take 20 minutes to answer, 30 minutes, 40 minutes, whatever it takes, depending on the bank. Monolines are way better because they don't have any, like physical presence. They only are online and they just do that. And they only do mortgages. And therefore, when you call them on IVR going to 5 different, press 1, press 2, none of that happens. It's just easier to get hold of them because the only thing that they do is mortgages. And then B lenders are also great because the only thing that they do is mortgages. So banks, lose points there, but honestly, sometimes you don't actually require the service. So I'll not pay a lot of attention to this. Flexibility wise, banks are just banks, so flexibility, there's no flexibility. The ratios are the ratio. This is called lending flexibility basically. So if you have low income and if you're doing a 20% down, banks will have a limit to how much they will lend you. Monolines will be almost the same. There are certain exceptions, there, but still, almost the same. B lenders are great here because I'm self-employed. I don't take a lot of personal income and they still lend me money based on 1 year of personal income plus a little bit of retained earnings in the corporation. So that's great, and therefore B lenders. Now the reason why I'm telling you all of this is monolines are great at one thing, which is lower penalties than the banks. And let's just take an example of that. Now let's assume that you have a $750,000 loan at a prime minus 0.85. Now the rates can be different depending on who you are and when you are taking the mortgage. I've seen lower rates as well, but let's assume for simplicity 3.6% interest rate is prime. Prime is at 4.45 minus 0.85. Variable rate for 5 years with a top 5 bank, and the other option that you have taken is the same thing but with a monoline. Both want to break the mortgage in 3 years. Now, the way penalties will be calculated will be on two numbers. The first one is the outstanding balance. We need to understand what the outstanding balance is. So in this case, let's assume that in 3 years, they paid down $50,000 of their loan and their outstanding balance is $700,000. The rate remains the same. I'm not taking a lower rate, higher rate. It's just for comparison between these two examples. The monoline penalty will be simply 3.6% divided by 12. So your monthly interest rate that you're paying multiplied by your outstanding balance, the $700,000, which is equal to basically 2,100. That's 1 month of interest that you're paying multiplied by 3 because you have to pay 3 months of penalty, and your penalty will be $6,300. In case of a big bank, they don't calculate on the rate that you have. They calculate on either the posted rate, which is higher, and most of the times it's at prime rate, which is 4.45%, divided by 12, multiplied by your original loan balance, and sometimes even higher than that, depending on the bank that you're going with. And their penalties will be higher for 1 month, which will be 2781 multiplied by 3, which is equal to 8343. So it's almost 25% higher, your penalties, if you're going with the top bank versus monolines. And the reason why it's lower for monolines is not because they're special, it's just because their overheads are much lower. They don't have physical presence. They don't have to pay, fancy people. They can actually make do with lower costs. Everyone is sitting in the head office. You don't need branches. You don't need fancy banners. You don't need TVs. You don't need all of that, right? So there's a lot of fanciness which is not required when you are an online mortgage lender, which a lot of these monolines are, and that's the cost that has been saved and therefore passed on to the consumer in terms of interest rates and penalties. Moreover, like I said, only one bank out of the top 5 banks, which is Scotiabank, has an adjustable variable rate mortgage. Mostly all the monolines are adjustable rate mortgages, and therefore it's just great. I especially like adjustable rate rather than having fixed payment variable rate, which I just don't understand. Now, I'm in no way saying that you should always choose a monoline over a big bank. If you are doing a 20% down, big banks make sense because you get access to line of credits. If you are not planning to break your mortgage at all, the first next 5 years does not matter because the penalties are the penalties, and there'll be no penalty if you don't break your mortgage or if you don't do anything with your mortgage. So I'm not saying that you should always choose monolines. All I'm saying is that these are things that usually we don't do. We don't calculate. These are fine prints, right? And it's just important to know what we are getting into. And we should not just be blindsided by or blinded by the fact that, these monolines are not top 5 banks and therefore they are bad. They are giving you money, not the other way around. And therefore, if anything, you are on the winning end because they are lending you money. So it does not matter who the lender is, who the bank is. What matters is what your fine print is, what your penalties are. And if a monoline is suiting you better because of the lower penalties, then why not? Now, talking about the fine print, it's very important to also understand there are certain monolines and even banks who would be very sneaky in some of the clauses, and some of these, I'm not saying they're doing it intentionally. Some of these advisors, even mortgage agents, they just don't understand these nuances in a mortgage. So I'll quote 4 or 5 clauses that I've taken from different, commitments, real commitments, real documents, that people sign, and I'll prove to you why lowest rate is not always the best rate. All this to say that the lowest rate is not always the best rate because there are certain clauses which you have to take care of. The first one is occupation by borrower. Now, there are certain lenders who are not authorized. They don't have the license to do rental properties. And let's say you buy a primary home with one of these lenders and you have an occupation by borrower. So that basically means that as long as you are living in that house, the bank will continue to give you the loan. As soon as you put that on a rent, because a lot of people do that, they buy their primary home, then they put it on rent, and then they move into another home. If you do that, you'll have to tell the bank, obviously, because you have to change your insurance, and the insurance company will tell the bank, or you will have to tell the bank, directly. The lender can actually pull the mortgage away, and you'll have to break the mortgage and move to another lender. And that is very cumbersome and extremely costly. There are many, many lenders out there. I can't take names because we work with these lenders as well. So I don't want to take names of, these lenders, but it's a certain lender that is 4 letters. I'll just say that. But they have an occupation by borrower clause, and there are many other lenders as well. If they do not do rentals, that basically means that this clause is highly likely in your contract. Then there's a bona fide sales clause, which basically means that you cannot break your mortgage before the end of term unless you sell the home. So you just cannot break the mortgage. It's not allowed. It's one of the craziest clauses that I've seen. And you can obviously port your mortgage, that's fine. You can move the same mortgage to the next house, but you just cannot break the mortgage, which I am just not okay with giving a product like this to my clients. Then there's something called a reinvestment fees. This is apart from the penalty that you pay, the IRD or the 3 months of interest, and it could be anywhere between 500 to 3% of your outstanding balance. This is just something that you need to look at in your contract, whether this is there or not, because it could cost you a lot more than just 3 months of interest penalty. It could be as much as 3% of outstanding balance. I've seen some lenders do that, and these are usually smaller lenders. These are not the top 5 banks, not many of the monolines, but there are certain cases where they dangle a really low interest rate and it comes at a cost, especially if you are trying to break the mortgage. Then there's a non-portability mortgage. It's very rare, but in some of the cases, your mortgage is not portable, so you cannot move your mortgage to the next house. And that's also why we do not use those lenders for our clients. Now, to summarize, interest rates aren't complicated. They're just poorly explained. And just to summarize, fixed versus variable rate, it carries different risks and not all variable rates are the same. And like I explained, the ARM is much better than VRM, at least in my view. It just gives you the true cost of mortgage every single time. And if you are not happy with that, just take a fixed rate. Rates move for completely different reasons. We talked about the variable rates moving because the Bank of Canada wants to control inflation or the economy, whereas the fixed rates are something that moves with the bond market, and they are two different reasons for why they move, and they can actually move in either directions, right? It's not like if the variable rate comes down, the fixed rate has to come down. It doesn't work like that. Fixed penalties can ruin your financial plan if you don't understand them, especially if you are taking a fixed rate mortgage for 5 years. I see a lot of people take a 5-year mortgage. It's very likely that you will break it. Plus, if you have those hidden clauses, it gets very difficult to get out of the mortgage, and you're much better off just staying with them. Variable rate, if you're taking a variable rate, then monolines are equal, in some cases better than top banks because of the low penalties, and the lowest rate might come with hidden clauses and expenses, and we talked about the 4 which are most common. And one last thing that I did not discuss in the video, but I have made a video on this before. If you do a less than 20% down, it does get you a lower rate versus if you're doing a 20, 30, 35% down. It's counterintuitive. And the reason is that when you do a less than 20% down, your mortgage is insured. You paid the insurance, but your mortgage is insured. And therefore, the bank carries zero risk. So if you default on your loan, which is high ratio loan, the bank actually does not have to bear the risk, and the insurer will pay the bank off. And yeah, that's why they give you a lower rate, because their risk is minimized. Something that I wanted to just, talk about before we close the video, because this kind of, I wanted this to be a very comprehensive guide on interest rates. I hope you like this video. Do share this with someone who, you feel is buying a home, but they don't fully understand how interest rates work. That's all I have for today. मिलते हैं अगली वीडियो में. तब तक के लिए bye bye.